provided that inflation continues to converge towards our 2% target, then it is appropriate to ease the monetary stance and cut rates in June. The biggest risk factor is the geopolitical situation, both in the Middle East and in relation to Russia's illegal, brutal war in Ukraine.
Let me explore those two concepts. When it comes to the Middle East, we've seen events over the weekend, Iran's direct attack on Israel. How could this escalate in terms of having monetary policy implications?
So far, the escalation has been avoided, and we've seen that the market reaction to the events was rather moderate, partly because there apparently was some preceding communication that enabled this to happen. But there is still a certain risk of escalation depending on what the central actors are doing. I don't think that neither the US administration nor China, for instance, would want to escalate or want to see escalation of this conflict. In the US, the Biden administration for political electoral reasons, and in China, President Xi, because of the need to get the economy going again. So these are kind of structural factors that are moderating the situation, but of course we know that the Middle East is a powder keg and a very challenging situation.
How unwelcome would another uplift in energy prices be when it's a fading component in terms of some of the inflation numbers?
It's difficult to speculate. I think overall, if you look at what has happened in Europe, is that energy indeed, as you said, was the driver of inflation, together with some other supply side shocks. Meanwhile, wage moderation, wage inflation functioned as the anchor. Now for the moment, energy prices have come down in the recent past, while we've seen some increase in wages last year. Now we are seeing again moderation of wages, and we are seeing that underlying inflation, core inflation neutralized from energy and food prices is also stabilizing towards our target, even though it is still somewhat too high.
I want to pick up on Ukraine because you mentioned that, and I spoke to another governor as well, that there are risks associated with Ukraine for monetary policy, that if there is a perception of a turn of events around the war, that it could have sentiment implications for Europe. How are you thinking about the war in Ukraine and the implications?
Ukraine is fighting for freedom and democracy, and it's essential that both Europe and the United States continue to strongly support Ukraine. This is an existential question for Europe and for the West. We cannot fail in this. That's essential. Of course, the current situation, when Ukraine has a difficult situation in its fronts with Russia, is feeding uncertainty into the European economy, and that is not good. What can be done is that we take such decisions that will seriously help Ukraine to contain the Russian attacks and defend itself.
Let me talk more with you about the playbook for the ECB then on monetary policy. We get to June, waiting for a few more factors. If there is a rate cut in June, how do we think about the potential for follow-up moves, and would another follow-up move in July even be possible? Would it be too quick for some members?
We take decisions meeting by meeting, and with the approach of data dependency. So now it looks like that as inflation is converging towards our target, as summer approaches in June, we should be able to take a decision on easing the policy stance and cutting rates. Beyond that, we are not pre-committing ourselves to any rate path, and it's essential that we continue to take decisions meeting by meeting and depending on the incoming date.